welcome to this online course on financial institutions and markets. I am Dr. Sonam Badhoria, Assistant Professor at Swami Rama Himalayan University. In today's session, we are going to explore a fascinating instrument that lies at the intersection of trade and finance: commercial bills. These instruments are among the oldest forms of credit used to finance transactions in both domestic and international trade. Though traditional in origin, commercial bills continue to play a crucial role in short-term financing, particularly for businesses seeking working capital solutions, or we can say the businesses who have need of short-term finances. So, let's begin by understanding what a commercial bill is. A commercial bill is a written, negotiable instrument containing an unconditional order by the seller or the drawer to the buyer or the drawer. The seller is the drawer and the buyer is the drawer of commercial bills to pay a certain sum of money at a future date. These are typically used in commercial transactions involving the purchase and sale of goods. Commercial bills are also referred to as bills of exchange and serve as a source of short-term credit for businesses. In essence, they allow sellers to receive payment even before the buyer makes the actual payment while converting credit sales into negotiable instruments. Imagine a situation where a textile manufacturer sells fabric worth rupees 10 lakh to a retailer on a credit term of 90 days. Instead of waiting for 3 months for the payment, the manufacturer of the fabric draws a bill to the retailer. The retailer accepts the bill, agreeing to pay the amount on due date. The manufacturer can then take this accepted bill to a bank or a financial institution who has the right of discounting the bill and get it discounted. The bank pays the manufacturer the discounting value of the bill immediately, deducting a small interest amount, and then collects the full amount from the retailer or the buyer on the date of maturity. This simple mechanism enables the seller to unlock cash quickly while the buyer enjoys a credit period. So, it is a win-win situation for both the buyer as well as the seller. There are various types of commercial bills and it's important to understand their classification. Based on the nature of the transaction, they are classified as trade bills or accommodation bills. Trade bills arise from genuine trade transactions involving the sale of goods or services, as we discussed in the above example. The accommodation bills, on the other hand, are drawn without any actual sale of goods or are meant solely to raise finance. In terms of the parties involved, bills can be documentary or clean. A documentary bill is accompanied by shipping documents like invoices, bills of lading and insurance papers. A clean bill is drawn without such documents and is usually based on trust only. Commercial bills can also be classified as demand bills or usance bill. Demand bills are payable on site on demand, while the usance bill are payable after a specific period. In the Indian context, issuance bills with their maturity period ranging from 30 to 180 days are most commonly used. These bills are widely used in domestic trade and also play a role in financing exports and imports under the regulatory framework of the Reserve Bank of India and the foreign trade policy. However, the foreign trade policy should have prescribed norms and regulations for such type of bills payments. The most crucial feature of a commercial bill is that it is negotiable, meaning it can be transferred by endorsement and delivery. This gives it liquidity and makes it a marketable instrument. Once accepted by the drawee, a will become a liability for the buyer and an asset for the seller or the financier. This acceptance makes the instrument legally binding. The involvement of a bank in the process adds further credibility, especially when the bill is discounted or sent for collection through a bank or a financial institution. The commercial bills serve several important functions in the economy. The first and foremost, they help in financing working capital needs by converting trade receivables into liquid cash. Businesses can maintain cash flows without waiting for the payment cycles to be completed. Another important function is they provide credit discipline. The existence of a formal written instrument with a due date and a legal obligation ensures that the buyer is committed to making the payments timely. The third important function of the commercial bills is these bills can be rediscounting by the banks and financial institutions, which means banks can also take the money before the maturity date, thereby adding liquidity to the financial system. They can also be used as collateral for availing loans, making them versatile instrument in corporate finance. The process of bill discounting is central to the utility of commercial bills. When a seller receives an accepted bill from the buyer, they approach a commercial bank or a financial institution to discount it. The bank or the financial institution verifies the authenticity of the transaction and the creditworthiness of the drawee. If satisfied, the bank or the financial institution pays the discounted value upfront and takes over the responsibility of collecting the full amount on the due date. If the buyer defaults, the bank or the financial institution has the right to recover the amount from the drawer. This process ensures that credit risk is shared and managed professionally. Another important concept is bill rediscounting. Once a bank has discounted a bill, it may choose to rediscount also. It may be rediscount it with another bank, financial institution or central bank depending on the prevailing policy from monetary policy and the other norms of Reserve Bank of India. In India, institutions like the SIDBI, the National Housing Bank have been involved in rediscounting operations. The Reserve Bank of India used to play a more active role in rediscounting, but with liberalization, the role has declined. Nevertheless, rediscounting adds depth and liquidity to the bills market. Ultimately, it increased the liquidity in the ecosystem of India. Despite the many advantages, the use of commercial bills in India has not reached its full potential. On the main reasons is the preference of both buyers and the sellers for cash or bank credit over bill-based financing. Many small businesses lack awareness of how bill financing works or lack the documentation required to participate. Additionally, issues like delayed acceptances, disputes over goods delivered, and the lack of a developed secondary market hinder the popularity of commercial bills in Indian ecosystem. Moreover, there are operational challenges like stamp duty, inadequate standardization, and the most important is the risk of default. However, recent developments have begun to address some of these challenges. So let's see what other developments has been done in the world of commercial bills. Platforms like trade receivables discounting system, in short it is known as trades, have been launched to bring transparency, digitization and efficiency to the process of bill discounting. Trades is an online platform where micro, small and medium enterprises can upload their invoices and approved buyers. Typically, large corporates or government entities accept them. Once they are accepted, these invoices are auctioned among financiers who offer discounting rates. The seller selects the best rate and receives immediate payment on the commercial bills. This system helps formalize trade credit. It provides financing at competitive rates and it also reduces reliance on informal credit sources. The Reserve Bank of India and the Ministry of Micro, Small and Medium Enterprises have been promoting the use of trades to increase the reach and impact of commercial bills. As more buyers and sellers get registered on these platforms and more financiers are participating here, the commercial bill market is expected to increase in the coming years. It is also showing a growth which is actually significant. Digitization makes it better. Legal framework is also strengthening it and it is also integrated with GST and e-invoicing systems which are actually boosting the use of commercial bills in trade finance by micro, small and medium enterprises. Let's consider a real world example. Suppose an auto parts manufacturer sells components to a leading car maker on a 60-day credit. Instead of waiting 2 months for payment, the supplier gets the car maker to accept a bill and uploads it on trades. Several financiers bid to discount the bill. The supplier selects the most favorable offer. The money is credited immediately and the financier gets paid on the due date. This process is seamless, paperless, and it is built on trust and transparency. This is how commercial bills are actually evolving the digital age, and the issuer is also getting the money in return and the buyer is also getting the money on time. In conclusion, commercial bills are a powerful short-term financing tool that supports trade and commerce by enabling smooth cash flows, promoting credit discipline and enhancing the liquidity. While traditional in nature, they are now being revitalized through technology platforms like trades. Their successful adoption requires greater awareness, supportive regulations, and robust informants mechanism. As businesses grow, they are using this type of platform and it actually becoming the supply chains more integrated. The role of commercial bills is expected to expand significantly with the growth of the digital payments and the digitization in the Indian financial ecosystem. As we wrap up this session, I invite you to reflect on a few key questions. What prevents more businesses from using commercial bills as a financial tool? Why they are still not using this type of tool even they are beneficial for them? How the platforms like trades transform the trade credit landscape in India? Are they actually transforming or some more things are required? And finally, what role should banks and regulators play in promoting the use of these valuable instruments? Thank you for being a part of this session on commercial bills. In our next lecture, we will turn our attention to the next instrument of money market, which is gilt-edged security, are debt instruments issued by the Government of India. They are known for their safety, liquidity, and strategic importance in financial markets. Until then, keep learning, keep thinking, and stay financially aware. Thank you and namaste.